What's happening there, guys, and welcome back to another video on our channel. In today's video, we'll discuss Peter Lynch's financial advice and whether he wants you to invest in the stock market. Let's get into it right now. It's no secret that Peter Lynch is one of the greatest investors of all time. The legendary fund manager got his big start while managing the Megallan fund at Fidelity Investments between 1977 and 1990. He made waves in the investment world and beyond after growing the fund's assets from $18 million to $14 billion, making it the best performing mutual fund in the world. Since then, Peter Lynch has built a $450 million net worth and has cemented himself as one of the most successful and well-known mutual fund managers and philanthropists in the world. Over the last few decades, Peter Lynch has given a lot of financial advice. He has also given countless speeches on growing money and has written numerous best-selling books, including One Up on Wall Street. Nearly 2 million copies of the book have been sold worldwide since its initial release in 1989. Although it is a pioneering book on investing that emphasizes the stock market, Lynch believes that he never advised people to necessarily go down that path. In a 2023 interview, the legendary investor explained, "The reason I wrote One Up on Wall Street was to help people that wanted to do investing. I'm not saying to do it, but if you do it, there's a certain way to do it. If you don't do it that way, you probably are going to have an unfortunate outcome." In his book, Lynch has repeated one of his top rules of investing: know what you own and know why you own it. He says buy only what you understand, believe in, and intend to stick with, even when others are chasing the next miracle. In another famous saying, the former Fidelity Megallan fund manager says that the worst thing you can do is invest in companies you know nothing about. Unfortunately, buying stocks out of ignorance is still a popular American pastime. According to Lynch, investing is similar to skills like ice skating or playing the cello. It's smarter to understand it first and then try it. If you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going to do it. But people are buying stocks anyway, he explains. When asked about what his advice would be for such people, Lynch said, "If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less, don't own it. Buy in your industry, buy what you know, buy local companies." Lynch stands by another classic piece of advice: always do your homework. According to him, investing without research is like playing stud poker and never looking at the cards. One of his other quotes from One Up on Wall Street further emphasizes the importance of research. It says, "Average investors can become experts in their own field and pick winning stocks as effectively as Wall Street professionals by doing just a little research." In his book, Lynch also talks about the importance of conducting independent stock research and acquiring knowledge about key investment metrics. One such metric he highlights is the percentage of sales, which advises investors to ensure that a product or service that appeals to them contributes a substantial amount of a company's overall sales. Another metric is the price-to-earnings growth ratio, or PEG ratio, which indicates the projected earnings growth, making it crucial to see companies with higher PEG ratios. Likewise, Lynch says that it's important for investors to investigate companies with solid cash positions and below-average debt-to-equity ratios. Peter Lynch advises investing for the long run. He believes that successful investors think long-term and stay focused on what's far ahead in the future. They picture growth in a matter of years and even decades because they understand that building long-lasting wealth takes time. An important key to investing is to remember that stocks are not lottery tickets, he says. Absent a lot of surprises, stocks are relatively predictable over 10 to 20 years. As to whether they're going to be higher or lower in 2 to 3 years, you may as well flip a coin to decide. Like many other legendary investors, Peter Lynch has always talked about the diversification principle. His Megallan fund had more than 1,000 individual stock positions, which is 5 times the number held by an average mutual fund. Lynch advises that an investment portfolio should not only be diversified, but also comprised of high-value stocks, meaning that it should include the most excellent stocks available for purchase. There's no use diversifying into unknown companies just for the sake of diversity, he says. A foolish diversity is the hobgoblin of small investors. That said, it isn't safe to own just one stock because, in spite of your best efforts, the one you choose might be the victim of unforeseen circumstances. In small portfolios, I'd be comfortable owning between 3 and 10 stocks. According to Lynch, it's never a good idea for investors to time the market and predict the direction of the market or chase temporary returns. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections that has been lost in corrections themselves, Lynch says. In case you're looking for the main takeaway, it's this advice from Lynch. Even if something looks good, you have to say, are they making money? That's when it gets interesting. Let me do some work again. The key thing is that researching stocks is fun. This isn't like doing your taxes. If you can't understand the balance sheet, go to some other stock. If you can't understand what they're doing with the accounting or you can't figure out what it does, when you look at the numbers, try some other one. You'll learn a lot. And with that, we've reached the end of this video. So do be sure to like, comment, and subscribe to our channel, as well as ring the bell icon to be updated about our latest content. See you next time, and bye for now.